Investing, facilitated by Encasa. This webinar is presented by BCNPHA in partnership with Encasa Financial. We would like to acknowledge that this webinar is being delivered from various locations on the unceded traditional territories on the unceded Coast Salish territory of the Lekwungen, Songhees, and Swanesh nations. We acknowledge that many of you are currently located in the ancestral homelands of indigenous peoples across the province, each with their own unique traditions and history. Before we begin, I will give you a brief outline of the format of today's session. The presentation will be approximately 90 minutes, followed by 2 break periods of an open question and answer period. Our goal is to finish up by 1:30 p.m. At any point during the session, please feel free to type in your questions at any time by using the chat feature. We will then do our best to address all questions during the open Q&A segments. This webinar is being recorded and the audience will be muted, which means that you cannot hear us, but we won't be able to hear you. Sorry, you can hear us, but we won't be able to hear you. Again, please type in your questions using the chat feature. Also, a recording of this webinar will be sent out within a day or so, and you will be able to access the PowerPoint there, so you don't have to worry if you miss something today. At the end of the session, we will send out a quick evaluation survey to everyone, and we would appreciate if you take in a minute or so to complete it. Next slide, please. And also, I would like to make a quick announcement for you to mark your calendars. Our Housing Central Conference will be held in November from the 15th to the 17th. We also been receiving some questions about if the conference is going to be in person or virtual. And this year is going to be virtual again, but the quality of the sessions is going to still the same one. So please mark your calendars and more information will go out soon. Next slide, please. Before we start the presentation, I would like to extend a big thank you to our BCNPHA education partners whose support has enabled online professional development opportunities for the community housing sector. Many of you may be familiar with Encasa, as many BCNPHA members are Encasa investors. Encasa Financial is a BCNPHA partner program who offers nonprofit providers with investment services. As a provider, looking ahead to future expenditures, the services Encasa offers include access to investment experts who understand affordable housing, for example, reviewing your building condition assessment, or best known as VCAs, and providing recommendations. Encasa has been a reverent supporter of various BCNPHA events, from grants, Housing Central Conference, and other in-person and online events. In fact, Encasa has sponsored over $25,000 of BCNPHA learning and educational events in the past 3 years. Now, I'd like to introduce our presenters, Mike Ames, Investment Funds Advisor, and John Osmond, Manager Client Services. Now, I will turn the presentation over to them, please.
Thanks, Mauricio. I'm happy to be here and hosting Building a Foundation for Investing today. As Mauricio mentioned, my name is Mike Ames, Investment Funds Advisor. I will go over a bit more of my background. I'm joined alongside here with John Osmond, Manager Client Services. He'll share a bit about himself with everyone as well. Now, just before we begin, we always like to get a good idea of where everyone's investment knowledge is, so we can kind of tailor the session to be more suited towards everyone's level of sophistication when it comes to knowledge about investments. So I'm going to have Tanya, I believe, will throw up a poll here. And if everyone could just take a quick moment and let us know in general, how would you describe your understanding of investments? Excellent being you're very well versed, you understand stocks, bonds, puts, calls, cryptocurrency, whatever, all the investment vehicles that are out there currently. You have some experience with them and or are knowledgeable of them. good means you've had some experience potentially with your organization or individually in terms of typically mutual funds. Either an investment advisor might buy or sell you individual stocks or bonds, or you've dealt with GICs, etc. In the past. Some means you're aware that investments are out there. You've experienced probably some GICs, some savings accounts, maybe a bit of an advisor through your bank or credit union, and then novices, obviously not much experience at all. So we've got about 6, 7, almost 80% everyone's responded here. So with the majority having some experience and a couple of you being good or excellent in terms of knowledge. So that's great. I will try and get a little more in depth for those of you that do have that more in robust knowledge, but I will try and keep it also high level for those that are still coming on board in terms of investing. So we'll just hide this off here. I think we can close that. So thank you everyone for providing that feedback. Today we'll go over, John and I will introduce ourselves, provide some background. John will then go into Encasa Financial and who we are and what we offer. And then we'll tackle some common challenges that I find come across often with most nonprofit investors these days. And then we'll describe a portfolio approach, which is an investment strategy that we find quite useful for most of our investors. They do take this approach. And then we will have a couple of question periods throughout and then again at the end. So welcome you to use the chat feature there. Mauricio will be keeping an eye on things. Might or might not interrupt me to get a poignant question across. But again, we will have some breaks throughout as well. So as Mauricio mentioned, my name is Michael Ames. I'm an investment fund advisor with Encasa Financial, as well as World Source Financial Management. I come with 10+ years of financial services experience, 8 of which were spent at a local credit union. I am registered dealing representative through World Source with the MFDA. Throughout my course of working with Encasa investors, I've developed a strong understanding of co-op and nonprofit housing sector investment needs, the challenges that they're faced with and how we can overcome some of those obstacles, and ways in which we can create a suitable plan for each housing provider's unique needs, although very common across the board that they're all facing the same sort of needs, making sure that it is suitable and tailored directly for that individual housing provider. I am also currently the president of my own personal strata council, so I do have a more in-depth knowledge of how the councils work, the sort of voting process, the meetings, the approvals, the motions, all those sorts of things, and then dealing with all the additional fun stuff that comes with being part of a strata council. So I understand that side of the business as well. I'll pass it off to John here and he can speak a little bit about himself.
Thanks a lot, Mike. Good afternoon, everyone, and welcome to the webinar. My name is John Osmond. I'm Manager of Client Services with Encasa Financial. I have spent, it's hard to believe sometimes when I think about it, but just over 25 years in various roles in the nonprofit, the affordable housing sector, nonprofits specifically. I started my career as a manager of a small 20-unit nonprofit. I'm actually based in Toronto. And during that time, I also spent a couple of years on the board of another nonprofit. So I've got a fair amount of on-the-ground experience. I worked at the Ontario Nonprofit Housing Association. That's BCNPHA's sister organization here in Ontario. I have a strong understanding of both co-op and nonprofit housing sector, having presented to many different boards and staff over the years. I've worked for the Housing Services Corporation, and my last 8.5 years have been with Encasa Financial. Next slide. So our journey, I wanted just to take you a little bit through the history of Encasa. The slide starts in 2002, but the history actually started a couple of years prior to that. Back in the late 90s, both the Co-op Housing Federation of Canada and the Ontario Nonprofit Housing Association communicated with the Ontario government and said that it would be a good idea for housing providers to pool their capital reserves. So whereas most of the 1,000+ housing providers within the province of Ontario have had their monies in credit unions and banks and so on. The organizations thought that it would be a good idea to pool that money, and we'll get into obviously the reasons for that shortly. And so that was actually proclaimed into legislation in 2000 under what was then the Social Housing Reform Act. I won't get into the details, but basically it was made into legislation, regulations followed, and then in late 2002, Encasa was created. At the time, it was called SHSC Financial, which stands for Social Housing Services Corporation. And so from 2002, for the next couple of years, housing providers started the process of transferring their monies from whatever formats and venues they had them currently invested into our fund. Fast forward to 2014, a couple of very interesting things happened. One of which is where we changed our name to something that flows a little bit easily off the tongue, Encasa Financial, rather than SHSC Financial Inc. And we changed our ownership, and I'll get into the ownership structure in just a moment. So that was in 2014. In 2018, we brought a number of services which were formerly handled by an outside party in-house. And so we'll get into that again in just a few minutes. So the years between 2014 and certainly into 2018 were very exciting for us, as we changed not only our name and our ownership, but the very nature by which we did our business, all the while protecting the capital reserves of the nearly 900 housing providers for which we handle about over $500 million in investments. Next slide, please. So our shareholders, so whereas previously the Housing Services Corporation, remember I mentioned SHSC, Social Housing Services Corporation, over the years the name was changed to HSC, Housing Services Corporation. They were our sole shareholder up until 2014. And then in 2014, when the ownership changed, we now have 4 owners or 4 shareholders: BC Nonprofit Housing Association, Co-op Housing Federation of BC, Co-op Housing Federation of Canada, and Housing Services Corporation. So this gives us broad reach in terms of being able to approach and bring on board clients from all across the country. The majority of which are still in Ontario, but we're bringing on more and more in BC, and we're very excited as the client base continues to grow in British Columbia. Next slide, please. So what are the sort of the expectations, just very, very broadly, as investors? Encasa expects that an investor, a housing provider, board, and staff will set investment objectives and utilize capital plans. And we'll be talking quite a bit more about capital plans and objectives and so on very shortly. But in a nutshell, managing their capital reserves. Co-ops have something called shared capital as well, and other reserves. And so basically we anticipate that a housing provider will have a fairly good understanding of what to do in terms of investing their capital reserves so that they get the best bang for the buck, so to speak. And Encasa's role in all of this is really to provide the advisor assessment and support and so on. And so we can help in developing investment plans, ongoing monitoring and reporting. We offer 3 different funds that we'll be talking about shortly, and so on. So basically, we are really there to provide the expertise to our clients, to our unit holders or our investors, if you will, in the fund. Moving on.
Great. Thanks, John.
So I'm going to turn it back over to Mike.
So,
you're welcome.
yeah. So I hope brings everyone up to speed a little bit more on who Encasa is. I would expect that many of you probably have a basic understanding to begin with, either being an investor yourself or have seen us at trade shows in the past, spoken to us, obviously seen our name in the info link communications that come out quarterly through BCNPHA. So I encourage you, if you haven't already spoken to us about your specific individual needs, feel free to do so. Always available by phone or email to discuss. It's challenging through these webinars to sort of get into individual situations and obviously provide advice on that. But certainly we can provide some general insights as to what we see other housing provider as investors doing with similar situations that you might be faced with. So speaking of which, I would like to go over today some common investment planning challenges that I tend to see arise with almost all providers that we deal with when it comes to the investment planning process. So we'll take you through a journey here with our friend ABC Nonprofit Housing Corporation. And you'll probably see some similar challenges in your own organization that they were faced with when we started this process not too long ago. So they had recently brought on a new executive director within the last 2 years. The board had had some turnover, but there was a few long-standing board members as well. And they were they'd built up some decent capital reserves, but they hadn't done much with it. And they were didn't really know where to start in the planning process. Some felt that once you sort of set up an investment, it would be set in stone and that they wouldn't really have much flexibility in terms of making any changes or accessing the funds once they got the investment ball rolling. There was also a bit of responsibility avoidance, and not by any particular individual, but sort of as a group, really. Up until this point that we got involved, they had just been investing in GICs through their local credit union for their reserves. So there was several that they had set up over the years, and they were all maturing at different times. The board had not really had any input in terms of how they were setting up any investment objectives for those funds. So the CFO was left with the responsibility of trying to manage these GICs on an ongoing basis. They all were maturing at different times. They were basically subject to whatever the going interest rate was at the time of maturity. And then the board had just said, yeah, make sure we can get at some of it if we need it, and then otherwise just get the best rate going. So the CFO was forced to just get a call from the credit union, hey, this is coming due. They would then mature and set up the renewal schedule to go into either a cashable or a non-redeemable at whatever the interest, 1.25, 1.5, whatever the case may be. So it was getting quite cumbersome for them to manage these frequent renewals. Also, because of this, that the board had been inherently conservative because they didn't really have the certainty that they needed as to when they had these capital projects coming due, when they would need the money, and whether or not they would be provided with additional funding for it. So because of this uncertainty, it had led them to be very conservative with their investments. Just wanted it to be there, safe and sound, preserve the principal, and earn a little bit of interest and be available if and when needed. They also had a couple of properties that they were managing. This had sorry, they had a couple of properties that they managed, two of which that were sold off. So they had some additional surplus sitting on the side, in addition to the capital reserves that they had for their current and ongoing building. And then they also had a little bit of surplus just for operating cushion as well. So they had these sort of three pools that all had conflicting objectives. They weren't really sure where to start with each one of them. And then one of the major ones that I see almost every time I speak to a nonprofit is they don't know whether or not they're going to receive funding for these capital projects. You know, they know BC Housing's there and available should the need arise, that they have a retrofit or a roof or a window replacement or whatnot, but they don't really know whether or not they'll get that funding until they actually apply and the time comes to have those repairs completed. So we'll go into that in more detail, but that was one of the other challenges they faced. And then, as most nonprofits incur, is they have cash flow and budgeting constraints. So they're always operating at slim margins, trying to avoid deficits from year to year, looking at additional sources of funding or fundraising to help offset the increasing operational costs year to year.
Mike, if I may just sort of jump
Sure.
in just for a second on responsibility avoidance. I've experienced this both as a staff member and as a board member. Often when faced with a packed agenda, a board will tackle those items that they're quite familiar with, whether it's tenant issues or arrears or any number of items that are familiar to them, and so many times you come up to the investments, reserves, building condition assessments, whatever, and eyes tend to glaze over. So it's almost as if it's like, okay, well, let's just put this one off until the next agenda, and then that continues to happen. So I just wanted to kind of point that out, that I've seen it firsthand. It's not an intentional thing necessarily, but just sort of oh well, this one can wait. It's not that important,
Yeah. So. No, I completely agree, and often I've been bumped month to month or quarter to quarter to even come and present at the board level, because they have such jam-packed agendas typically, and so many things to cover in such a short period of time. It is tough to set aside and go through the somewhat cumbersome initial on-taking of doing an investment plan. It is a bit of heavy lifting up front, I will admit, but once you get over that hurdle and you have the plan in place, it's almost sort of a set it and forget it. And then from there, it just takes regular monitoring. So your capital reserves or capital plan or investment category or agenda item for the meetings then becomes very easy to deal with, because it's, hey, you got your quarterly statement. Where are the reserves at today? Are we on pace to meet our goals? Do we need to increase, decrease, etc.? And it becomes a very brief conversation that people can have confidently because they know they have that plan in place. So yes, making the initial decision and taking it on can be a challenge sometimes, but I assure you the board and the organization in itself will feel much better once they do, because they feel that they have some fallback and a solid plan in place.
Indeed.
So thanks, John. So a couple, I'd like to get into two more specifically that I find are the biggest challenges. Is funding uncertainty. So we mentioned BC Housing's in place. They will come up and help fund these capital projects that will arise, but you won't know until the time comes. And you have to do the application. It depends on how much funds are available. And, there's also thresholds too that they have. If it's under, I believe the funding will be provided. And sorry, I should take a step back here. You are all the experts in terms of nonprofit housing provider management. You do it day in and day out. You're either, in a position of leadership with these organizations. Myself, I come from the investment planning, so I don't do that day-to-day interaction with BC Housing, and I don't actually fully grasp the process, the application, the receiving funds, the receiving grants, as well as you would. This is my basic understanding of what I hear from most investors when we're getting together to discuss a plan. So I'm not trying to come across as an expert as to what you do day in and day out. And forgive me if I do say something that isn't 100% correct. This is just sort of the general aspects that I've gathered over the years of going through this. So yeah, my understanding is that they will fund up to a certain threshold. Once it exceeds that dollar amount threshold, then they will require that you either refinance or redo your mortgage if you have one through BC Housing. So they do this based on the BCA. So every building that they have through the BC Housing program will have a building condition assessment. Ideally, you should have a capital plan that works in conjunction with the BCA. You can either do these on your own. BCNPHA also has a program that will assist you in developing your capital plan based on your BCA. And they also have a spreadsheet that you can use on your own and sort of tweak, which we'll go into a little bit more in further depth, but it gives you a good understanding of where your projects are at. If any are overdue, how many you have are competing, whether some can be bundled together and done as one project to hopefully save on some costs of doing separate renewals or retrofits. And then from there, we often see that the reserves and overfunded is typically not the case, but usually underfunded capital reserves. The time we might see them overfunded is if there are some additional surpluses sitting on the side outside of the reserves, because either you've been told by the auditor or BC Housing that you are, overfunded or underfunded for the year and that you need to contribute a bit more or take some out and set it aside in another reserve that isn't necessarily mandated or restricted to specifically the capital reserves. So some of the scenarios and that we're faced with, and the capital planning tool is very, very useful in looking at these because you can run multiple scenarios with it. So I always take it and say you're able to develop sort of best and worst case scenarios. So you're either getting no funding, you might receive partial funding, you might get full funding for it, or it exceeds that threshold and you have to go through the refinancing process. Or worst case scenario, you have an emergency that comes up of something that wasn't on the plan and costs a large amount of money to have repaired and either eats into those reserves or just comes at not necessarily a planned interval that you were able to position yourself for and prepare yourself for. The other probably most common one we see is multiple properties. So actually, sorry, I just wanted to jump back here and speak to the building condition assessment. So these are done typically by either a BC Housing consultant, the BCNPHA can provide them as well, or there's just outside private consultants or engineers that can complete these assessments as well. So they are non-invasive assessments, meaning it's basically done by the eye. So they'll go and look at the condition of the roof, they'll look at the condition of the windows, the exterior, the boiler, all these types of things, and they'll take their best educated guess in terms of what the remaining lifespan is. And it typically is, does it look in decent condition? When was it originally installed or built? And what is the typical or average lifespan of that specific component of the building? So built in 2000, we're looking at it in 2010, boiler looks good, lifespan's typically 15, 20 years, whatever the case may be. Okay, slap it in there. It's due in, 2020 is when our boiler is due to be replaced. Whether that's the case when you get to 2020 is really up to the individual actual component, how well it's been maintained over those years. And if you're getting lucky that you've had it outlive its life expectancy, or if you were able to complete some minor repairs along the way that potentially has extended its life expectancy. So it's really, these are completed with best educated guesses, but you in yourself know your buildings the best. You might have a in-house maintenance person, or you're just aware of various aspects or problem areas of each of these buildings. So it is your responsibility to then go through the BCA as you're building your capital plan with a fine-tooth comb, and make adjustments where needed. So it might say that the building envelope's $330,000, but you've spoken to 2 or 3 contractors that have provided quotes where they're in the range of 250 to 270 maybe. So you could then adjust the plan to what the expected cost would be and have a more accurate reflection of what is going to be needed when it comes up. You can also put projects together and bundle them. This is useful too, that might incur some cost savings, but really play with it and amend it as needed. It's a fluid document. And it's yours to adjust. So I do encourage you, don't just take it for face value, and really put in that additional legwork of making it as accurate as possible, because that will help drastically in the planning process.
Mike, I'd just like to echo what you said there, basically in terms of the board and staff, really being the experts, and to obviously use the BCA, the building condition assessment, as a tool, and a very important one, but to, as you said, make sure that the reality of your situation doesn't differ too much from what's on paper. And also, I've noticed over the years that many nonprofits and co-ops, the worst thing that they can possibly do, and I've seen this time and again, is they pay good money for a BCA, and then it goes onto a shelf or a bookcase and gathers dust. And so review that BCA at least annually to ensure that you're up to speed and you're making wise decisions.
Yeah, for sure. Yeah, use it as a tool in the planning process throughout, not just for investments, but funding for everything. You're going to need to know where you're at and what you have coming down the pipe in terms of disruptions to your day-to-day operations, because that's typically what these retrofits or capital improvements are, not only to the organization and the staff, but also to the residents and the tenants of these various buildings. There is a disruption that goes with all construction. So you might be feeling additional complaints. Contractor might not show up when they say they're going to show up. There's all these additional stresses that go with it. So you want to be as prepared as possible in advance, so you have the resources available to you to deal with those challenges as they occur throughout the actual improvement process. So the other challenge that we were about to get into here was multiple properties. So as a nonprofit, you might have 4 or 5 or even a dozen different properties in which you have residents living, each of which would come with its own capital reserve pool and typically its own BCA and possibly its own capital plan. As we mentioned, that many capital reserve pools are typically underfunded for what's showing is going to be needed in future years. Or often what we'll see too is that you get to a point in which you're showing items that are past due or past their renewal date. So you've managed to get by through some minor repairs, or again, you got lucky and got an extended lifespan of that actual item. But it's showing, it needed to be done in 2018, and here we are in 2021, and we still haven't done that improvement. So not only are the reserves underfunded, but we have items that are past due too. And you're dealing with this on multiple properties. So it can become very, very challenging to say which one are the actual priorities, which ones are going to come up first, which ones we are more likely to actually get the funding for if we do the application. You know, what we've found is that typically the reality is you're not going to be doing all these improvements at once. You might have one or two major projects a year, even if you're managing several properties. I just alluded to sort of the challenges that go on with managing the improvement process, the construction process, the disruption to tenants while it's ongoing. These are big things to deal with in your properties, and you know, they take a lot of time and effort to ensure that they go as smoothly as possible. They stay on budget, right, and they stay on timeline too. So, you know, in reality, on paper, it might show that you could do 5 or 6 projects a year, and you've got 3 or 4 that are overdue, so you've got to include those as well. It's just not the way we're seeing it unfold in real life. So with that in mind, we sort of like to suggest taking a step back and look at the bigger picture. And we can do this through what's called reserve amalgamation. So if I'm dealing with a nonprofit that has multiple properties and those multiple BCAs, what I typically suggest they do is they look at them all together. So you can put them together and say, okay, we've got 5 properties, each of which have $200,000 in capital reserves set aside. So we're sitting on $1 million collectively. We have some older buildings and some newer ones. We know probably the newer ones aren't going to need improvements until later, but we do have a couple items that are past due on the older buildings. So by putting all those BCAs together and pooling the reserves, what I find we can start to do a little bit more easily is find, you know, maybe 3 to 5 priority projects and start to list them in order of importance, in order of timeline, and in order of you know, funding likelihood. So then you can look at them and say, okay, what's the sort of largest upcoming project that we have? You know, we collectively have $1 million here, but we know our next biggest project, the next 5 projects that we're going to do, the biggest cost for any one of them is $200,000. So of that $1 million, let's take 200,000 and let's either leave that in the bank, you know, savings account, GIC, if we know it's going to be needed, you know, let's say this year for sure. I would definitely recommend doing that. If you know it's not going to be until 1 or 2 years down the road, then you can look at potentially putting it in, you know, a very low risk, low volatility type investment project or product that is liquid and accessible when needed, but won't see much volatility or fluctuation along the way. The worst thing you can do is set aside some money, know you're going to need it in the short term, and then all of a sudden when it comes time to actually accessing it, there's been a correction in the market and your 100 or 200,000 that you once thought was there is now 190,000, right? So by ensuring they're in low risk, low volatility, you know, virtually principal guaranteed products, then they're safe and sound, and it's your little safety net that you can then tolerate any fluctuation or corrections the market might throw at you. And it provides you with a lot longer of a time horizon for the remainder of those funds. And then what we can do is, as those projects come due, and you go through the process of getting funding, getting partial funding, not receiving funding, and actually having to access the funds, you then look to replenish as you go. So you might have 5 priority projects listed. You get lucky with the first 2 and get full funding for them, but the third actually, you're required to utilize some of your capital. You know the remaining 2 are still going to cost X dollars. You've then accessed some of those funds. You can look to the remainder of the pool to draw down and replenish what you've taken out to ensure that you still maintain that little safety net of capital that's quickly accessible, liquid, and principal sort of protected, right? So as those projects you keep knocking them off the list and completing them, you then just have that you would keep accessing. So it really allows us to sort of run and provide a lot better investment strategy for the remainder of the funds. Otherwise, conversely, if what we've done, and I will mention this before I forget to do it too. I hear everyone sort of jumping up and down saying, "Oh, how are we going to amalgamate?" What I have found with providers is you are able to sort of track your multiple properties and their reserves internally. So whether it's on a spreadsheet and you've got 123 ABC Street, 456 XYZ Street, all these multiple properties and their capital reserves, you can just track those on your internal spreadsheets, even though they are going into, say, one large GIC or one large investment portfolio where they're all amalgamated. You can still allocate those percentages or specific dollar amounts to each of those properties via on paper and through journal entries or spreadsheets internally for your financial statements. And then as you add to them, you can do the same thing too. And then as there's investment returns on them too, those then get allocated proportionately as well to the different pockets or pools that each property contributed to. So alternatively, you can also look at just doing multiple individual accounts for them. But I find this to be not as good of a strategy because there's so much uncertainty surrounding all the plans. And that you're then looking, again, you get into that sort of GIC renewal sort of type mentality where you're not really working for the big picture, you're just looking at it on a case by case or individual property basis. But by pooling that, again, it allows you to extend your time horizon, invest or take on a little bit of increased aggressive position for your investments, try and focus a little bit more on growth for that remainder and increase them as much as you can. It also provides entities the ability to be more agile. So you can then deal with those emergencies as they occur, or you can adjust the plan as needed, whether funding comes through or funding doesn't come through. So this is an often overlooked strategy that I find many nonprofits can drastically benefit from when they are dealing with multiple projects or properties and have competing priorities through each of the BCAs or capital plans. So what does it actually look like on paper? Well, when we put it, and this is just a segment, obviously it goes out many more years as well too when you put it all together. But this is a great tool that you can get through BCNPHA, and it's part of the capital plan. And as I mentioned earlier, with those best and worst case scenarios, you can run multiple different ones on this. So you can say, okay, let's say we get funding every time for each project. What does it make our reserves look like then? Or what if we don't get funding, or what if we have to refinance in year 7, or we renew our mortgage at that point and there's some additional funding coming through? What impact does that have on our reserve balance? You can also set it to say how much return you're getting on your capital reserve. So if you intend to leave it in those GICs at 1% these days, or if you look to invest it accordingly with a portfolio that's suitable to your specific needs, and in which you can potentially receive 2, 3, 4, 5, 6, 7%, depending on where you situate yourself. You can then input that return amount and really get a good visual and see how your balances will grow over the years based on those different levels of return. So I do really, really enjoy this tool, and is one that we use frequently with helping providers how to actually develop their investment plans. And I do recommend doing the best and worst case scenarios for multiple ones, and it really puts you in a position that you can assess your sort of worst case scenario risks for any major emergencies, underfunding, what position it'll put the nonprofit in if that actually were to occur. And then if everything goes as planned, tickety-boo, and we get our funding every year and everything goes smoothly, where we can actually grow our organization to then ideally put more services or roofs over our residents and tenants' heads, right? So that's the main objective here. And these are just tools in which you can utilize to maximize your potential growth of your reserves and over time. We all know nowadays, you hear it, hyperinflation. We've seen the cost of lumber. We know the cost of labor is increasing. Pre-COVID, I remember hearing stories of, you couldn't get trades out to your properties to get jobs completed or improvements done. If they did, there was a premium with their costs or charges because, many of them lived in the suburbs and it was such a hassle to get out to the city. And there was so much work everywhere in terms of construction that they were able to charge a, $25, $50, $100 premium just to come do the work in the city, for example. So, all the components that go into manufacturing a boiler or an elevator, or just accessing the lumber needed to retrofit some windows or do some siding, all of these materials and components have input costs that are just, growing day to day here with the price increases. So we know that what's stated on your capital or BCA plan in terms of cost isn't likely going to be the true cost 3 or 4 or 5, 6 years down the road. So if you're not treating your reserves appropriately in terms of investing them, then you're really lagging behind because we bank on the standard inflation being 2%. We're seeing it slightly higher right now, and who knows how long that'll go on for. But if you're not at least growing them at that 2% rate, then you're just going to be left in the dust in terms of trying to pay for things when the time comes for it. So it is prudent at the board level, at the staff level, to manage your reserves and your surpluses and any funds available you have to invest prudently. And as a person in the same position would do so. I hear a lot of this conservative approach. No one really wants to be the one to suggest investing in something to then have a correction take place and all eyes are turned back on them. But the reality is you have a fiduciary duty as a board and or staff to manage these assets accordingly. And if you've gone through the planning process, done your due diligence, set an investment policy statement in place, realistically, should there be a market correction, all eyes wouldn't turn to you because the reality is it's not just going to be your individual investment that's down at the time. It's going to be the markets collectively, right? They act in unison. Our funds are no different than any of the other funds out there in terms of how they'll tend to ride the waves the same as the market does. So if you've put all those pieces in place, there's no reason as to why a board or staff should be faulted for any type of correction that the market might see. I'll give a quick snippet of our COVID process. So when it started to hit, we saw, the markets were down 20% across the board, right? And most of our investors, because they had a plan in place, they didn't actually have to draw down on any of their reserves at that time. Yes, it sucked because they saw their portfolio decline dramatically, but because everyone was so uncertain about what was going on, no one was getting any improvements done on their buildings during the time, and they were able to sort of just let their reserves be, do their thing. The correction happened, and then the markets returned and stabilized very quickly after. We actually finished 2020 with positive returns on all three of our funds. So staying the course, not panicking, not selling off because of having that proper plan in place really did pay dividends for our investors. And they weren't really frazzled by by any of the market corrections because A, they had that time on their side, and B, they were managing the different operational challenges of COVID too and weren't actually utilizing their reserves at that time. This is just part of the extension of the capital plan, and it just gives you a good visual of where you would see any of those years in which you would have a negative drawdown and potentially what you can do to correct that through funding, additional funding sources, refinancing, etc. So I encourage you, if you have any questions up until this point, now would be a good time to pose them. If not, I can continue on in a moment here towards the portfolio approach that we find is valuable for most investors.
Mike, while we're waiting for questions, something popped into my head about, you mentioned window upgrades earlier, and although the ramifications are more on the operational side, housing providers that sometimes are looking for the best bang for the buck, so to speak, will look at building improvements that will also increase energy efficiency. And so they'll look at windows and doors and insulation and that sort of thing, and say, well, this may not be at the top of the list. However, if we do this, and sometimes your building condition assessment will actually include a section that talks about energy efficiency. If we replace our windows, we will, on the operation side, save X number of dollars. So it's kind of popped in my head.
And there's also, there's funding out there available too for those energy efficiency programs, right?
Indeed.
So they are worth exploring because you can receive some funding, up to 20, I believe sometimes 30% of the cost for it. And that's before the operational savings that you mentioned too, right? So I believe they do provide, payback periods, right, with these energy efficiency assessments.
That's correct.
Can then show you, it's going to take us 3 or 5 or 6 years before these, LED retrofit is paid off or
paid for itself. Exactly.
Yeah.
Yes.
Yeah. All right, Mauricio, I don't think I'm seeing anything coming through here, so I think we'll continue on in the essence of time and get to some of the actual investing pieces. So,
yes, Mike, I don't see any questions from attendees. Please feel free to ask any questions you may have, and Mike and John will be happy to answer all your questions fast. You can continue, Mike. If a question pops up, I'll let you know.
Sure. Thanks. All right. So portfolio approach is one we find that is typically most useful for most of our investors. There are many different investment strategies out there. Each will vary dependent on the individual investor or entity. We want to encourage nonprofits to ensure that they have an investment statement policy in place. This can be created at the board level, and it does sort of, I like to say it's a cover your butt policy, but for any board member or members that were apprehensive about making those investment decisions in fear of a potential correction or it reflecting poorly on them, this investment statement policy can just be the document that protects them in terms of here's our process, here's what we went through, here was our due diligence, here were our targets, here's what we would allow the investments to be invested in, here's what they're not, here's how we're going to evaluate our investment advisor, what targets we're going to set, and what thresholds they're comfortable with in terms of risk tolerance and time horizon for specific pools. It can be as concise or short or elaborate as needed, depending on the level and size of the nonprofit. We do find that most investment strategies will take in the same several factors: assessing the purpose of the funds, the goals and or investment objectives of those funds, the time horizon associated with them, and the risk tolerance levels that they're comfortable with taking on with those investments. So a combination of all of those factors will typically determine the appropriate asset mix used to formulate a portfolio. So what actually goes into a portfolio? Well, there's several main asset classes that you'll typically find with most advisors, with most investment portfolios that you look to set up. Because we had a decent level of knowledge, I won't cover many of them in too much depth, but it's good for you to be aware of them and how they formulate components of the plan. So cash equivalent, these will be your GICs, your savings accounts, anything at the bank level typically, and then bonds, fixed incomes. These will be issued by federal governments, provincial governments, municipal governments, corporations. They come with different credit ratings, different interest rates. They are fairly stable. They'll always pay an interest. If you have them held within a fund, that fund's market value can go up and down, but you will always be within the fund receiving interest payments that are paid out via dividends. And then equities and stocks, these are ownerships in companies that can be accessed globally. They're always traded on an exchange, publicly traded corporations. So those are kind of the three pieces that when we look to create a portfolio that we're taking into consideration. So how do these different asset classes perform over the years? And this is a really good illustration as to why diversification within your portfolio is so important, as well as timing the market can just be super challenging too. No one really knows how these assets are going to perform in any given year. Yes, there's some future outlook that can lead to some predictions, but whether or not they perform that way is always sort of up to chance. I always like to say, if I had a crystal ball, I wouldn't be sitting here talking to you. I'd be sipping a Mai Tai on a beach somewhere. So it is very, very challenging to determine that, which is why diversification is so important. So I'll take you through a brief little journey here with ABC Housing, Nonprofit Housing Corporation. When we started working with them back in 2005, we developed an investment plan we had in place. It was the first time they were looking to invest outside of their traditional comfort level, which was savings and GICs. We created a moderately, very conservative portfolio. It was largely income or fixed income bond based. However, they did have some exposure to equities. I believe, if I recall, it was either 30 or 40% at the time of the portfolio. So we started that in 2005. Everything was going fine for a couple of years. They were pleased. They were making quite a better return than they were seeing historically with their GICs. So they were quite pleased, when we were doing our reviews initially annually. And then all of a sudden, 2008 came along, and they saw their equity piece of the portfolio drastically decline when we saw the global recession hit in 2008. Although we had a plan in place, they'd come from a very conservative position. This really freaked them out, and they actually decided to sell off the portfolio at the time, or at least the equities portion of it, and move some of it actually to cash, and then the remainder put it into bonds, because bonds had actually performed quite well that year when we saw the recession initially hit. Despite our recommendation of sort of holding the course, they had the time on their side. We knew there was probably a recovery going to come after this recession. We just didn't know how long that would take, although they had several years ahead of them before they need to access the funds. They decided against that, and they sold off. So the next year, they were still holding all of bonds, but they saw the equities piece actually produce a very, very decent return from what it had produced the year previously. So they thought, maybe we should have stayed the course as suggested. But they decided, well, we had made the decision, nothing we can do about it now. So they let it go for another year, in which again they saw equities perform very well that following year, and then they're really starting to think, geez, we kind of shot ourselves in the foot. We sold at a loss, and now here we've missed out on these 2 years of good returns, and which we could have been recovering in our portfolio. We still haven't had to access any of it over this time. So they finally actually made the decision then, okay, we should get back to our original plan. Let's introduce some equities back into the portfolio. So they did this in 2011, just in time to see equities take a fairly drastic decline again that year. So they had tried to time the market, but they really didn't know how anything was going to perform year to year. And they just, they sold off at a loss, and then they bought back in at a high, which then subsequently declined right after it. So this was a very good example of how challenging it can be to try and time the market, and why it is often suggested that you don't attempt to do this. They always say it's not timing the market, it's time in the market that leads to positive returns over the long run. So you always have to remember that if you've set up a good plan to begin with, and you're sticking to the plan and there's been no material changes, there's no reason as to why you should try and maneuver and tactically plan and get in and get out and hop on a hot or cold streak of any specific stock. It's way too hard, and even the professional money managers don't necessarily take that approach in terms of setting up investments that they provide to their clients. So if you want to just take a quick visual, you can track some of these equities or asset classes throughout the years and just see how quickly they bounce up and down from return year to year. So, having a bit of each in your portfolio goes a long way. They say, diversification is the only free lunch in investing. So we do recommend that it is prudent for our investors to be well diversified to protect yourself from any shock from any one of those asset classes. They tend to typically work inversely of one another too. So if you have exposure to many, then when one declines, one of the others might be up, right? So it always sort of keeps you in that more stable range than holding all your eggs in one basket and following one asset class up and down as it goes. So remember that when you're setting any of your portfolios up. So how do we actually determine those asset allocations? Well, this will be different and unique for each investor, and each investment fund manager or firm might have a slightly different name or acronym for each of these. But what they are all getting at in essence is your asset allocation of how much do we hold in income or fixed income versus how much we hold in growth or stocks or equities, as they're also known by. So it's balancing that out of 100% portfolio, how much is held within each. And as the percentages change, you'll see either your potential for return will increase, your risk tolerance will increase. And in order to actually be in a position where you're taking a more growth mentality or more aggressive position, you also then need to have that time horizon on your side to help tolerate any fluctuations that you'll see throughout the market. So the more aggressive, the longer you need in terms of time horizon. So this just shows you where you'll fall on sort of the spectrum or continuum of risk versus return, and where your objectives fall for that as well. So in terms of how we do it at Encasa, John mentioned we did offer 3 mutual funds, which I have a bit of a video explainer that's from our website, but I find it does just do a good job of providing a brief description of each of our 3 funds. And then from there, what we'll do is we'll work with investors as to how to tailor that, how much of each one they should hold, if they should hold all 3 to begin with. And that's really dictated by your BCA and your capital plan and what the board or staff is comfortable investing with as well. So we'll just hop over here and I'll let everyone take a quick movie break here. It's not too long. I think we're almost at 2 minutes or so, so enjoy. Sorry, I guess the sound's not coming through here. I don't know whether or not I can get it to work. Let me just try and still no sound, eh? Okay, one sec here.
Mike, we can send the video after the presentation so they can have it and have a look at the runtime if the sound is not working.
Sure, I'll just try this because I've turned it to internal.
Okay.
So we'll see if that works, and just give me a quick heads up if it doesn't, okay?
At Encasa Financial, we offer a suite of funds designed to meet the investment goals,
Working now?
requirements, and
Yes.
risk appetite of our
Yes.
investors. Interested in learning more about the Encasa funds? Here are the basics you need to know. We offer 3 mutual funds designed as a group to align with your risk tolerance, investment needs, and liquidity requirements. The Encasa Canadian Short-Term Bond Fund invests primarily in high-quality Canadian short-term bonds. If you are seeking higher levels of current interest income compared to money market fund investments, are ideally planning to spend your funds in the short term, and have a low tolerance for risk, this may be the fund for you. The Encasa Canadian Bond Fund may be a fit for investors who don't need to access their funds over the short term, but are planning their spending needs over a medium term. This fund invests primarily in investment-grade bonds of Canadian governments and corporations. Are you seeking exposure to companies both inside and outside of Canada? The Encasa Equity Fund is broadly diversified across the global stock market. It is designed for investors who do not need to access their capital for a longer term and are comfortable with the return risk profile of investing in equity markets. If this describes you, this fund may be for you. It is important to take a balanced approach when developing your investment portfolio so that it can work optimally for you. Get in touch to learn how we can help your organization to achieve its investment goals.
One of the things that we tell our investors, Mike, and of course this is not news to you, but to our audience, is invest according to when you need to spend the money. And so I think that really just sort of outlined that really well in that short video. Is, you know, we've got short, medium, and long term, and that's what the investment advisors will assist in the planning process in terms of determining what your short, medium, and long term goals are.
Yeah, exactly. And that's, you know, where those plans, capital plans come into place too.
Yeah.
You know, we certainly appreciate the challenges and the uncertainty, which is why I really wanted to highlight some of those common challenges that we see across the board almost always with all investors, that there is that, it's really hard to come up with a concrete plan when there is so much uncertainty involved with. But what you can do is position yourself to make your best educated strategic plan based on the information you have available at the time. We mentioned sort of that set in stone mentality. No investment plan is set in stone, and they are fluid and they do change from time to time. And this is part of which we encourage you to maintain your investment plan. And here's some of the tactics that you can use to do so. I had mentioned that the biggest challenge we sort of see is finding the time to start the actual legwork of developing your IPS and putting the plan in place. That's correct in the sense that, there's a bit more paperwork involved in the account opening process. You have to determine your initial objectives and everything, and where you want to structure and situate the portfolio. But once that heavy lifting's done, it is almost a set it and forget it, right? And they almost go on autopilot, these plans, that you don't really need to do much adjustments after, other than doing your sort of annual contribution or setting up monthly contributions, or drawing down and doing redemptions when the time might come that you're actually looking to complete those projects. And after it's set up, then you look at it becomes one of those items on your agenda at board meetings. We review it regularly, we do it quarterly. If there's been no material changes to what were in place during your initial planning process, there's really no need to make any major adjustments. You can evaluate that plan, quarterly, annually, however you see fit, and you compare it to the objectives that you set out to begin with. So one of the things that we can see occur on portfolios is what's called portfolio creep. So this is where you might hold let's say all three funds, two of which are fixed income, one is equities. So we see those fixed income asset class versus that equity asset class. And the equity asset class might have performed very well over the last 2 to 3 years and potentially returned, let's say 8% per year for the last 3 years. And you hadn't done anything up until that point. You'd just gone, oh, great, we're getting a good return on our portfolio. Whereas the bonds had actually only done, let's say average 3% for those same 3 years. So you might have initially started with, let's say, a 50-50 asset allocation between those two asset classes. But here we are 3 years later, the equities have performed much better than the actual bonds, because historically that's their nature. They do have a growth objective versus more of a capital preservation objective or income objective of the fixed income asset class or the bond asset class. So now you're not at your 50-50. You might be at, let's say, 65-35, right? Because they've performed differently. So now you have an increased exposure to growth objective or equities than you had initially wanted or were comfortable with in terms of your risk profile or your investor profile. So you're no longer at that 50-50, you're at 65-35. So if there were a potential correction, let's say tomorrow, your portfolio is going to actually be impacted a lot more drastically than it would have had you had been at that 50-50 asset allocation, because you're now holding more in stocks. So this goes to show what portfolio creep can do to your investments. And it's why it's important to A, review regularly, and B, rebalance as needed. So typically we'll see this being triggered at a 5 or 10% point or threshold. So you can set this into your IPS and say we will rebalance either annually if needed, or when any of our holdings exceed our initial target allocation by 5 or 10%. So you'd review this, and let's say you would have caught those equities taking off. If you had that 5 or 10% threshold, you would have sold some off, purchased more bonds, got you back to that sort of 50-50 allocation that you'd intended to begin with and want to maintain throughout the plan because there's been no material changes. So that's what reviewing and rebalancing can do to help maintain your investments. And then you would basically just have to make any changes if there were any material changes to the strategic goals of the organization. You might sell a property, you might acquire another one, you might introduce additional services to your tenants or residents that requires more capital, or it might be a change in strategic direction of the nonprofit. So these types of things can be material changes, at which point we recommend and encourage you to review your investment plan at that time.
Mike, we have a question from Sylvia. Can you restrict investments to SRI funds?
Yeah, great. Thanks, Sylvia. I appreciate the question. And that's one sort of piece we hadn't really gone into in essence of time, but we are virtually at the end of the presentation, so we can go into a bit on the actual responsible investing piece of it as well. So we act as a social purpose investment fund manager in Encasa Financial, and that's partly because our shareholders are all member associations within the social or affordable housing sector, but it's also because we were sort of born and bred on the responsible investing mandate and policy, which we've always had in place throughout inception of our funds up until today. It has become more robust and adhered to more strictly over the years. And as there's been more and more research and growth and information about responsible investing, we're able to sort of tailor and tweak our policies as we go. And we are striving to always get better in those. But Sylvia, all three of our funds do have our SRI and responsible investing policy mandate applied to them. So they will all go through both positive and negative screens for any of the securities held within each of the funds. So we eliminate certain industries to begin with: alcohol, nuclear, weapons, adult entertainment, tobacco, all these types of industries where a corporation would generate the majority of their revenues from those business operations. Those would actually be ineligible to be incorporated in the fund. And then from there, of the actual securities or companies that are left available to invest with, we look at which are the ones in the various sectors or categories that are doing the best in terms of environmental protection, resource renewal, pollution reduction, equity on boards, good labor practices. There's so many different components that we look at that actually each company is then provided with a grade into how they're doing with these in these various aspects. And then from there, the ones with the highest grades are the ones that are selected to be incorporated in the portfolio. And the reason for this is that we find over time, the corporations that are doing the best they can for environmental, social, and governance factors tend to be the ones that have good long-term strategic plans in place that actually produce long-term revenue growth year after year, continue to pay or increase their quarterly dividends if they're a corporation that participates in dividends, and that they typically don't end up as a bad news headline, which can negatively impact a share price for any corporation. I mean, now you just see it when we had our friend south of the border, could affect the stock markets through a tweet, and now Elon Musk affecting prices of stocks and by what he says as well, right? So not having any one of those particular corporations that might end up as a bad headline and can come with some more drastic volatility in terms of share price The ones that are just steady Eddie, doing the best they can, have a good strategic plan in place, and are contributing to the communities in which they operate in, and are making sure they are adhering to the best practices when it comes to environmental controls, social impacts, and as well as governance through the organization. So yes, all three of our funds are restricted to SRI because that's all we actually have available. We have those responsible investing screens on all three of the funds that we offer.
We have another question here from Henry.
Yeah. Okay.
CRA restricts investment types for charities. Do your funds meet CRA's investment restrictions for charities?
So the charity question, I would have to see the specific legislation that's in place or the act that's in place that's restricting it via CRA specific to charities. I know we have come across many of the providers that are have operating agreements in place through BC Housing. There is sort of wording around what you can and can't invest your reserves in when you are under an operating agreement with BC Housing. Obviously, there are different operating agreements, whether you're through CMHC or let's say like a federally regulated co-op or provider, but BC Housing does encourage the investment of reserves to go through so many to be invested prudently, right? So they don't actually restrict providers from investing with us unless you have, you know, a very unique operating agreement or one that's potentially federally regulated. But I can get back to you. I believe it's Henry on that. I'll have to look into it a bit more, and maybe you and I can have a conversation on the side. You can tell me a little bit more about what you're referring to, and I can do a bit of digging and come up with a more concrete answer for you on that. But I appreciate the question, and yes, I know that is one of the apprehensions that a lot have. So, and then Rod. So Rod has why do so many investment policies seem to be over? Yeah, no, I agree, Rod. So Rod's question is, why do investment policies seem to be overly complicated and restrictive? I think the IP should set goals and objectives, but not tell the professionals how to do that. There needs to be some room to operate. Yeah, correct, Rod. And I think potentially what you might be alluding to is more of a discretionary advisory role, which we don't actually take on. So we do require the input from the investor in terms of setting those objectives. And then we can't just trade discretionarily. We have to actually take trade instructions from the investor as to whether or not they want to rebalance, sell a bit off, add a bit more. But by having that investment policy in place, which you originally alluded to, I have seen some that are super elaborate that you're referring to, where they, you know, talk about, you know, what specific ones you can and can't invest in terms of responsible investing, what the specific target allocations are. For us, we try and take more of a simplistic approach, which is why we actually only offer the 3 funds, because we understand that they are varying levels of size, sophistication, knowledge, etc., and management of all these housing providers across the spectrum. So you might be a small one-off mom and pop, you know, nonprofit where you've got one building with 12 units in it, and here you are next to a nonprofit that has, you know, 12 different buildings that manages, you know, 400 or 500 total units, right? So you know, those would be the ones that would obviously potentially have a more sophisticated investment policy versus the smaller 12-unit provider. But it doesn't have to be that way. Like you said, you can just basically say, here's our, you know, 2 asset allocations we're comfortable within. Here's what our target return objective is. And as long as that's consistent with the projected returns of the asset classes and the percentages in which you're holding, you can then accurately evaluate it against those benchmarks for those assets classes, and say, okay, what's reasonable for us to expect in terms of an annualized return based on 50-50 split sort of thing, right? And then it gives you a good baseline as to how you evaluate it on a quarterly or annual basis. And you can make changes and amendments as needed there. And that's how you would also evaluate the performance that the investment advisor is providing for you based on their direction too, right? So, you know, if you set unrealistic targets, the advisor should be the first one to say, hey, look, Rod, I don't think we can get there with 80% fixed income and only 20% equity if you're trying to achieve a 6% annualized return, right? So, but yeah, you should leave some room to operate, and I appreciate your question. I hope that response gave you the answer you were looking for, or provided some more insight for the additional members and attendees. So I think we have, well, 2-3 minutes here. If there are any other questions, feel free to throw them in there. If not, and you wanted to talk about your unique or specific situation, feel free to message myself or John. I have, I'll throw my email up at the end here, but I did have one final poll that we'd just like to go through. If everyone is able to let us know here, what we're doing is, based on what we've discussed today, do you feel confident that your organization has the foundation of a sound investment plan in place? So I talked about a few things today that you might have not considered or thought in terms of the investment planning process. You know, one of multiple properties and amalgamating your reserves, the other of how to deal with that funding uncertainty, right? So, you know, if you do have a plan in place and you feel confident in it, you know, congratulations, that's excellent. I'm pleased to hear that. You know, just be sure that you are revisiting them from time to time. If you have any material changes, it's always good too, if you have new board members come on board, to take an extra minute in the meeting to go over how you guys got to that plan. Just so they're all on the same page. I find that over time, you get some turnover by the boards, and then, you know, 3-4 years down the road, here's 5 new board members that have all come on, and none of which were part of the planning process originally, and really have no idea as to why they have this investment plan in place. So revisit it from time to time is the best advice I can provide. And if you don't have one in place, no shame. It's, you know, definitely a good time to start is now. So reach out at any time if you need some help, or visit BCNPHA, ask them to get the ball rolling on a BCA or a capital plan, to put those pieces in place, that we can then have that foundational piece that we can grow into a suitable investment plan for your organization. So about 5 responded here, almost a 50-50. So yeah, good to see, and thanks for throwing that up, Tanya, and you can take it down if you'd like, or maybe I have to. There we go. So yeah, I would encourage you to get going. I know it takes some time at the next board meeting, but at least start the conversation. And I'm hearing from a lot of providers nowadays that, you know, so-and-so has been instructed to go out and ask their credit union or bank about investment options, and then they come to us as well to find out what we have to offer. So there is some focus being placed on your reserves now from a lot of organizations as to how to properly invest those. So we're all for that and encourage that. And, you know, as a sector, we have to work together, talk to your neighbors, talk to your fellow nonprofits, and ask them what plans they have in place, ask them who they deal with for their investments. It's, you know, we should all be working collectively here to share as much knowledge with one another to ensure that we're successful as a sector, which we're proud to be a part of. So I thank everyone today for joining us, I know you're probably webinared or Zoom called out at this point of the pandemic, but you know, half decent way to spend the afternoon, I hope. And I hope everyone was able to take at least one tidbit of knowledge back to their organization that they can share with others to help improve their situation.
Thank you, Mike. I will now put the evaluation survey in the link to the chat, and please fill it out and give us your feedback. It's very important for us so we can keep delivering these type of sessions. Also, I would like to thank Mike and John for the valuable information that it was shared today, an excellent presentation, and for your time. We would also like to thank attendees for your questions. As mentioned, we will be sending the link to this recording and the visual recording piece to all participants with the next few days. The recording will also be hosted on the BCNPHA website at bcnpha.ca education/webinars. Thanks again, and take care, everyone.
Thank you.
Yeah, thanks. And thanks, Rod. Appreciate that last comment there. Thank you, everyone, for attending, and hope to see or hear from you soon. And if not, we can reconvene in November at the Housing Central Conference. So